Hi, I'm Max Keiser. This is the Keiser Report. Oh, Davos is starting, I think, tomorrow. This is the major global swap meet for dealers of weapons of mass financial destruction, and they compare notes on how to destroy each other's economies for fun and profit. Stacy Herbert?
Max, if you do a Google search for Davos 2012, you will find out why the banksters are behind SOPA, why they want SOPA. Because as you see, the first two results are World Economic Forum. That's actually the group that puts on Davos. Number 3 result is from MaxKeiser.com. That's before CNN, before The Telegraph, before The Guardian, before all the international news media. We're first. And what does it link to? But original artwork from William Bonsai 7. You can see this right here, Davos 2012. Too many banker species, one planet, no future, World Ponzi-nomic Summit.
Many species. They've got the gorillas, the central bankers. Then they've got the primary dealers. I think there's 28 of them. These are the ferrets that are kind of manipulating markets to try to ease that push of quantitative easing into the global economy.
Well, Max, let's turn to some banker species in the headline. The first one, the correlation of laughter at FOMC meetings. This is the central banker species. The FOMC is the Federal Open Market Committee at which the Politburo sets global interest rates. Well, apparently somebody had the clever idea of actually looking through the transcripts of the meetings. And they found that the number of recorded laughs actually increased in frequency from 2000 to 2006, the peak of the global financial bubble. In 2001, the FOMC erupted into laughter 16.5 times per meeting on average. In 2003, it was over 19. In 2005, 27. And then in 2006, the FOMC burst into laughter nearly 44 times per meeting.
Yeah, that's because they should be printing money or doing something responsible, but instead they're smoking this money. There's who are Federal Reserve chairmen? You know, the problem is that this stuff can make you see hallucinations, which I'm not, you listen to these guys, it sounds like they're stoned and seeing oh boy.
Max?
This is some quality money printing. I can't believe this quantitative easing. Where can I get a nickel bag of this?
I think you've got high in your money supply.
Holy smokes.
Well, yes, so they were laughing all the way to the top. Here's another species of banker, Max. It looks like these people are followers of maybe Timothy Leary. Goldman Sachs enters £8 billion parallel pay universe.
£8 billion parallel pay universe? Drop out and pay yourself a huge bonus. I think Timothy Leary said that in between acid hits.
Well, of course, many people who get a bad batch of LSD often are found standing on the edge of buildings saying, "I'm God, I can fly."
Right, that's Tim Geithner. He's down there at the New York Fed. I'm flying. Look, he thinks he's in Titanic. He is in Titanic. The entire economy is sinking, and he thinks he's getting hugged by Leonardo DiCaprio.
Well, payout by investment bank equating to $238,000 per employee provokes anger among unions in the UK. But you always did say, Max, that they would have to go off-planet to pay off all the derivatives they've spun.
No, well, look, I mean, the unions are upset, but the unions have no place at the table. The unions have been taken out of the equation many years ago. This is a battle between savers versus speculators. That's the battle. Unions and jobs are gone. It's only about people who have capital who want to save and get an interest rate on that savings versus borrowers who want a low interest rate on their savings to borrow and speculate and get bailed out.
Actually, Max, okay, this brings me to the next species of banker, and that's the global organizations like the IMF and World Bank. Because the IMF, Christine Lagarde, said that we need to bring unions back to the table because IMF warns of threat to global economies posed by austerity drives. Reflecting the IMF's concern about over-aggressive deficit reduction programs, the joint statement said governments should manage fiscal consolidation to promote rather than reduce prospects for growth and employment. It should be applied in a socially responsible manner.
Well, let me explain something. I'll give you a lesson in economics in 20 seconds. It's centrally planned. It's central bank planned. It's low interest rates to favor speculators to the point where unsustainability has now gripped the global economy by the throat, forcing one of two outcomes. And there are only one of two outcomes. A, central banks begin to raise interest rates, which would in fact spur interbank lending, which would be inflationary, which is what they want to curb this deflationary nightmare, or B, they raise minimum wage. They double or triple minimum wage. That would also cause inflation. That would also cure the problem. Those are the only two outcomes. Raise rates on interbank lending or raise minimum wage. To suggest anything else is only favoring the speculators and the borrowers to the detriment of everybody else who's not one of those people who are borrowing with impunity with zero risk. Remember, they're not taking risk. Like Mitt Romney, graduate of Bain Capital, when they were out there in the private equity space slashing and burning companies left and right, remember, he took zero risk. His cost of capital was zero, and the cost of making a mistake was zero. He's just a guy who steals money, who doesn't drink coffee.
So Christine Lagarde is saying that governments in Europe should stop cutting things and actually start investing. And in particular, investments should target skills and education and thus equip people for the future. But of course, the last 30 years of these banking species running the world has been the exact opposite. It's been the Bain Capital model of extracting as much equity as possible from your community, including the capital of human knowledge.
Right. Well, Christine Lagarde, to give her enough ammunition to duke it out there at the IMF level with some kind of gravitas, if they're not going to raise the wages for workers or give them some education, then you've got to start raising rates at the central bank level. Those are your two choices. So present it in this way and give them the, either-or solution. Because if she just goes down one path and leaves the other one completely unguarded, she will not make any traction in her arguments whatsoever.
Of course, the other way to look at it is that the IMF, the day before, had only requested an additional $600 billion from the taxpayers of the world. So maybe she's trying to pretend to them, make a false promise that, hey, we're going to invest back in you, and hopefully you'll have a better future.
Oh yeah. She's the old trick bag. She knows what to say to get people to write the checks. She's a good saleswoman, but she's an assassin because these policies are killing people with their collateral damage of risk, bombs exploding in people's faces and destroying their lives. That's terrorism.
Well, another banking species, Max, is the famine victim. Hedge funds may sue Greece if it tries to force loss. So hedge funds are considering suing Greece in the European Court of Human Rights after Greece said that they're basically demanding a 50 to 60, 70% haircut for these bondholders.
Well, okay. So the hedge funds are going to sue Greece, right?
And the European Human Rights Court.
Right, because the hedge funds know that they're the ones that are heading to The Hague in these human rights courts. So the best defense is a good offense. Because they're trying to deflect their prosecutions in these human rights courts. They're trying to deflect this Nuremberg trial for hedge funds and private equity groups like Romney's Bain Capital, because they know that they'll be at the head at the end of a noose. So they take the offense. They say, oh, it's the Greek people need to be. The Greeks, oh, we're going to sue Greece because we raped and pillaged them, so we're going to sue them. I mean, this is an old strategy, and the Greek people, I'm sorry that your country has been sold out to fast food franchises and cell phone networks, but hey, 5,000 years of history, you had a good run.
Well, I just mentioned the famine victims. Here's the banker who's had too many munchies, I guess you could say, over his lifetime. Surely President Obama is joking about this have Larry Summers run the World Bank thing. So Larry Summers apparently is being floated as a possible World Bank chief head.
Floated?
Floated, yeah, like a big giant Macy's Day balloon.
Which?
But the article points to the Ron Suskind book, Confidence Men, and it talks about some little bits from inside that book, inside the Obama White House. And one of the interesting things is that apparently Larry Summers threw major hissy fits when he was not nominated to be Ben Bernanke to be the central bank chief to replace Alan Greenspan. In particular, he got very angry with Timothy Geithner, who didn't support his nomination. So this is what he wanted to be. He wanted to be the Politburo in chief, the fat cat at top, smoking those Obama dollars.
Who's a fatter pig? Is it Larry Summers or Chris Christie? I'd have to look that up. Who's the biggest pig? But, you know, the fact is that Larry Summers, and you read his editorials in the Financial Times, they're preposterous because he keeps harping on about the same thing for years now. You just need to increase demand. Increase demand by stoking the markets with more credit and giving people more means to borrow more money to go out there and stoke demand. Never does he say that there should be maybe a supply. Maybe a supply of manufactured goods, for example, maybe savings that would create capital for your capitalist model. He never talks about supply. He only talks about demand and how to increase demand, as if we're living on a planet that can support hundreds of millions of people in the U.S. and billions of people around the world all demanding stuff and borrowing money to get that, fulfill their demand, but never, ever actually manufacturing a single thing unless you're at Foxconn, 800,000 slaves making iPods and iPads all day so that people in New York can flash around Central Park with their little gadgets and making googly eyes at each other, even though they're supporting slave labor.
You know, there has been a massive supply of financial products under him, a massive supply of fraudulent financial products. He was actually pushing Alan Greenspan to be less regulating of fraud. And Alan Greenspan was one of the maestros of allowing fraud to flourish as a way to provide liquidity to the markets.
Okay, let's examine that for a second. A supply of financial products that are all based on debt. And debt is the killer of the economy. And people demanding more debt is not the same thing as fulfilling a supply curve with a demand curve. This guy, Larry Summers, is an abomination. Everything he touches turns to garbage. He uses his position in government to invest in things like Square, that new online startup company, to insider trading, inside information, market manipulation, another terrorist, Christy Lagarde, send them all to The Hague, hang them all. Stacy Herbert, don't go away. Stay right there. We're going to talk about more stuff. You too. Stay there.
Observe nature and discover its beauty. Communicate with the wild and learn. Test yourself and become free. See what nature can give you on RT.
Permission free. Accreditation free. Transport charges free. Arrangements free. Risk free. Stereotype free. Download free broadcast quality video for your media projects at freevideo.rt.com.
Welcome back to the Keiser Report. I'm here with Stacy Herbert. We're talking about Davos, the global preeminent confab for financial terrorists to gather and swap ideas about financial weapons of mass destruction, how to blow up countries and make money. So what else you got for me there, Stacy Herbert?
Well, Max, we've already established that the regulators, bankers, economists, and all are all batshit crazy, or they're stoned on their own money supply.
I think we've shown that pretty convincingly.
And they're all meeting in Davos. Now here's Robert Johnson, an economist and a former currency trader for Soros, another big name always appearing at Davos. And he says, economists, a profession at sea. How to keep economists from missing the next financial crisis. Notice that he says financial crisis. It's not financial crime wave. And I think that's an important thing to think about here. He says that it's all about the mathematical models in particular, that we need to relook at these. Financial market models, for instance, he says, tend to be constructed with building blocks that assume stable and anchored expectations. But as far back as 1921, Frank Knight of the University of Chicago made the useful distinction between measurable risk and unknown unknowns, which he called radical uncertainty. Knight's point was that in a period of radical uncertainty, expectations couldn't be anchored because they have nothing to latch on to.
Well, this is an ongoing debate in economics and finance. And what people fail to understand is that the liquidity, the capital that's used to fuel capitalism comes overwhelmingly from the losers. The people who make losing bets, the people who make losing option bets, the people who make losing bets on all kinds of investments. That money gets recycled into the economy and gets used by those who are able to make better bets, who make better use of that capital. If, in fact, you had an economic model that would give some predictability to outcomes, then you would eliminate the entire sea of speculative capital that forms the basis of what we call free market capitalism. So his very premise is faulty to the core. It shows a complete lack of understanding of markets and finance. It shows a slavish devotion to academic theories that have long been discredited. And it shows a major media who is incapable of challenging these charlatans.
What I'm saying is that he's failing to account for crime. And crime doesn't fit into any financial model that we are presently using. If I steal your rabbit, that's not in any sort of model that is going to explain how to operate the global economy.
Well, that's not necessarily true, because piracy, as that concept is understood, was the driving force, for example, of the American economy. The term Yankee comes from a version of the Dutch word for pirate or thief, because when America was started, they stole so much intellectual property from Europeans. The entire Internet, Google, for example, is driven by piracy. They use other people's work and they organize it in a search algorithm, and they create a multi-hundred-billion-dollar enterprise. So stealing, theft, and piracy are all in the eye of the beholder, and that's part of this ongoing SOPA-PIPA discussion. But what this gentleman is suggesting is that the underlying mathematical models need to be improved, which indicates or hints at the fact that economics and finance can be somehow predictable. But as Steve Keen has shown and others, when you bring predictability into the arena with you, you're no longer talking about economics and finance. You're talking about hard sciences like physics or chemistry, which is not the same as economics. You're guaranteed to draw bogus conclusions. And to prove that, look at what the economy's gone through in the last 4 or 5 years. Failure after failure after failure, because you've got these charlatans thinking they need to tweak the model instead of just letting the free market be free.
My point is that the sort of market rigging and, say, packaging faulty mortgages that you don't actually own the title to, that sort of fraud, I believe, hurts an economy. If your financial markets are 40% of the economy and 60% of those guys are fraudsters, then you need to factor in that your economy is based on fraud. And, how long can, fraudulent economies can survive and last. And as you said, the, American economy thrived on fraud in the beginning. If we're going to go with that model, if you think, selling fraudulent mortgage-backed securities is a good thing, you have to say, okay, how many fraudulent products can we get away with?
No, I think that it's okay for somebody to try to sell a fraudulent mortgage, but there also has to be room for someone to try and sell a legitimate mortgage. The problem in the U.S. economy and the global economy is that fraudulent mortgage sellers squeezed out all the viable sellers of real financial products. It's like a cancer, they totally killed the host. So there is no competition. Competition would be great. The American government, for example, if they want to cure the financial problems, charter 10 new banks that simply do plain vanilla utility banking, borrow and lending, and you'll see most of these problems go away because they won't be able to exist in a real competitive environment. But this administration doesn't want competition. These corporations in America, like Microsoft or others in the software space or in the Wall Street banks in the banking space, they don't want competition because they're not free marketeers. They're war profiteers. They're kleptocrats. Now, to your point, again, competition will be helpful. If you have an economy that is based entirely on fraud, like it is in America today, there should be exchange-traded funds, or ETFs, that are tied to fraud. I should be able to buy Goldman Sachs and JP Morgan fraud, which is a package of all their dark exchange, off-balance sheet accounting crimes, traded as a publicly listed liquid security. I should be able to buy into their fraud. Then do all the fraud you want, but let me be participating in your fraud. But you can't have 100% kleptocracy available only to the top 1%. If you can have a kleptocracy, let everyone enjoy the kleptocracy. Or have a free market competition, free market system, and let everyone enjoy the free market. But don't have a kleptocracy that nobody can participate in for 1%, and then basically abandon everybody else to just basically fight amongst themselves in some medieval torture center.
So let's look at the next headline, price manipulation, look for motive. This is Janet Tavakoli, a Chicago-based expert in derivatives, and she's looking at the manipulation of silver prices in the 70s via Alan Rosenberg. And what it is that he was an arbitrageur, started out legitimate, based on a legitimate arbitrage opportunity between silver certificates and what the government would give you in exchange for that silver certificate. Rosenberg then figured out a way to make some extra money when he sold his silver certificates. He instructed his broker to go into the commodities trading pit first thing in the morning and bid up the price of the first silver contract each day. Rosenberg overpaid and lost money on the contract's 10,000 ounces when he sold the contract later in the day. By then, the price fell back to the actual market manipulation-free price. But as the result of his price manipulation, Rosenberg sold, say, 100,000 ounces for an extra 3 or 4 cents per ounce. His profits from the price manipulation on 100,000 far exceeded the losses on the 10,000 ounces of silver.
Right. Well, we see the exact same thing, for example, when Morgan Stanley, JP Morgan, or Goldman Sachs buys credit default swaps on bonds on a country like Greece that are worth more if the country goes out of business. So they'll buy a few of the bonds in Greece, but it doesn't matter if the country goes out of business because the credit default swaps will make more on the failure of Greece. So this is an old trick. It's been around for quite some time. It happens when you have these markets trading on different securities in different ways and different points of leverage, and arbitrage opportunities, if there was genuinely a free, open, liquid market, tend to shrink down to a point where it's not profitable to really go in there and exploit them because that's part of a free market. But what we have today is a market that's it's not price discovery, where buyers and sellers come in and the result is a price. No. What we have today is that price is determined beforehand by Wall Street for various securities, and then they have algorithmic program trading come in and do the trades necessary to achieve that price. So it's a priori manipulation where they already have the price they want as determined ahead of time, and then they fill in the trades afterward to get to that price. That's a complete opposite of what you'd expect would be happening in the traditional price discovery. This is just another example of it. It's happening in every single market around the world. It's enabled by computers and high-frequency trading. It's a form of siphoning or pilfering. It's a form of larceny. It should be outlawed if we had anyone doing any that kind of regulation, which they're not.
She says the anomalous price moves are a red flag, and it seems regulators aren't even looking for them. If regulators ever did decide to launch a genuine investigation, the place to start is with those who gained the most in the short run or those who avoided the most short-run loss from the price moves. And, you know, this notion that, oh, I lost some money is something that Lloyd Blankfein has used in testimony to Congress. Lloyd Blankfein stood in front of Congress and said, the proof that I did not commit fraud is that Goldman Sachs lost money on mortgage-backed securities. But as this is showing, was he making a huge amount more. And as Nomi Prinz has said, he probably did, or Goldman Sachs probably did on the other side.
Right. They say, we lost $10 here. They don't tell you they made $100 here on the same trade. Yeah. Conversely, and the same kind of thing, is that Geithner and those folks will say, the taxpayer made money on TARP. They made money on the bailout.
Yeah.
They made money on General Motors without disclosing, in fact, on the Fed's balance sheet and elsewhere, they actually lost 10 times more than they put in. So it's another form of deception.
And she finally ends, Max, the MF global debacle and the price action in precious metals, especially around options expiration dates, show how lost our regulators are and how mistaken their overseers in Washington remain. So let's talk about some more precious metals manipulation here. Overnight long, intraday, short gold fund more than doubles in just over a year, generates 43% annualized return. So SK Options came up with an idea of going long overnight in gold and short intraday gold. If you look at these charts, here's from 2001 to 2012. Had you done that, you would have been annualizing at roughly 43% per year. Since 2009, that would have been 64.4%, and in 2011 alone, that was 143%. What does this say to you, Max?
Manipulation. It's indisputable proof of manipulation. Now, to put that into context, that 43% annualized rate of return, let's say compared to Warren Buffett. You know, he does 22% a year. And he's considered the greatest investor of stocks in the world. How about George Soros? During his best 10-year stretch in history, he was annualizing at 32%. And that requires a lot of research and trading and going on TV pretending to be an altruistic guy. Here you just have a simple numbnut strategy of long during the night, short during the day. You're annualizing at 45%, which, as you just pointed out, you're doubling your money, every 2 years. And at that rate, of course, you would become the richest person in the world very, very quickly. And I'm going to call my broker. I'm going to get on this right away. As a matter of fact, what am I waiting for? I got to get me on the phone.
Well, those sort of price anomalies shouldn't happen so consistent in such smooth, geometric, consistent patterns like that if there was any rule of law. Now, speaking of rule of law, and speaking of Chicago, in which many of this manipulation happens, Chicago, murder-free, shooting-free for first 24-hour period in nearly a year. So Chicago is celebrating. Apparently, there's been no murders for a whole 24 hours, the first time in a year.
Congratulations, Chicago.
But it's been, of course, about 30 years since there has been a 24-hour period of manipulation-free, of financial murder-free time in Chicago.
Exactly right. While nobody was getting shot in the head with a bullet on the street, they were losing their country and their wealth due to financial weapons of mass destruction, all being discussed this weekend at Davos. Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
All right, well, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. If you want to send me an email, please do so at keiserreport@rttv.ru. Follow me on Twitter, Max Keiser, Twitter account. Till next time, Max Keiser saying